incorporation of ESG, and better access to digital technology, including data analytics. And all of this requires a huge access to talent, and also, by the way, a driver for diversity and inclusion. So that's your opportunity, that's the challenge, because one of the things the EU is concerned about is the concentration of financial expertise in London, which is not the case for other cities in the EU. So I think London will still have a very important role to play. And by the way, it's much more important to be integrated and doing things together than working on silos.
Hi everyone, welcome to the 6th session of Leeds Finance Summit 2021. My name is Yusung Kai, I'm the president of Leeds Finance Summit this year. The Leeds Finance Summit is an annual conference bringing together industry professionals in an educational platform. This event is being organized entirely by students at the University of Leeds. It is a joint venture forming Leadership Society, Cryptocurrency and Blockchain Society, and Trading and Investment Society. We would like to thank all societies who helped us with the promotion of our event. Leeds FinSci Society, which is a student-run financial newsletter and publication, will bring coverage of the event. The theme of the summit this year is post-COVID world, and we will cover topics of taxation today and sustainable investment tomorrow. Today is the 6th day of Leeds Finance Summit, and I'm delighted to be joined by Duncan Meredith. Duncan Meredith is the principal at Meredith Tax LLP, and we'll talk about taxation in the post-COVID era today. Thank you for joining us. The speech will last about 40 minutes with a Q&A session. Now I'll share my screen and Duncan can start his presentation. Hi. Sorry, I think you are muted. Need to unmute.
I find with these things, it says join with video and then you have to click video, and join with sound and you have to click sound, and yeah. You never know where you are. Okay, well, hello. I can only see 3 people. Is that right?
Yeah. I guess it's because not many people are interested about topics of taxation, because
Sure.
we do have a lot of attendance before, and I think there might be a clash with another society event today. So I'm sorry.
Okay, no problem at all. Okay, I'll set off. I'll carry on as if I've got 100 people.
Okay.
Right, so I'm Duncan Meredith, and I'm principal of Meredith Tax LLP, and I give tax and business advice. And that's on the back of Chartered Accountancy and Chartered Institute of Taxation qualifications, nearly 30 years working in the profession, and now 10 years running my own practice. And I'm going to talk about my own career and the profession generally, and then I shall outline the main points of our taxation system before looking at what is going to be different, possibly. And there'll be a question and answer session at the end. The theme of my academic career was the trend away from science towards the arts. Starting from a science bent, I studied maths, physics, chemistry, and biology to O-level or GCSE, which meant for me science experiments, science theory, maths equations, and no essays. But for various reasons, I was uncomfortable with studying chemistry A-level, so I chose physics, maths, and further maths for A-level. And physics itself was my best subject, but looking at university, it seemed too much like hard work, 30-hour weeks even in the 3rd year. And I enjoyed maths, and it seemed to require just pen and paper, with only 8 hours in the final year. So I ended up at Leeds University graduating with BSc Mathematics in 1981. But even then I hated applied maths and I tended towards pure mathematics and statistics. As to a career with pen and paper, I looked into accountancy, law, and banking. And audit accountancy was the first that came on the milk round before Christmas. So that's what I ended up doing. And I've now signed up for 3 years of exams to get the ACA qualification. Now, in my year, generally, 25% of student entrants had done accountancy or finance related subjects. 9% had done mathematics. So that left a whopping 66% from the vast range of other subjects: science, engineering, English, languages, even theology. Personally, I enjoyed studying, and the exams always led the practical experience. And I liked tax in particular, so I ended up transferring into tax. And then 1 year after completing the ACA exams, I took the CIOT, Chartered Institute of Taxation, final exams to become a CTA, and my tax career really began. Ironically, that means mainly writing reports, so much for avoiding essays. So in terms of my professional career, I spent 6 years at Price Waterhouse, a large firm who later merged with Coopers & Lybrand to become the Price Waterhouse Coopers of today. I spent 6 years with BDO, who were a medium-sized firm, who then merged with Arthur Andersen, another large firm, and I was another 5 years with them. I then spent 10 years with a York independent firm, which was quite small, before starting my own practice, and I've been 10 years plus. At Pricewaterhouse, I did first audit and then tax, and I got my qualifications. At BDO, I was doing tax, but that's incorporated international PLCs, owner-managed businesses, and the voluntary sector. Arthur Andersen, I hung on to one large quoted property group, which I'd been involved with, and in the end, I spent 11 years being their tax guy. But otherwise, it was new to Arthur Andersen, the owner-managed business sector, and we set up a enterprise group, a specialist group to look after them, and I was Mr. Tax in that. At the York independent firm, I learned the business side of owner-managed businesses, and then I was ready to set up on my own, and that's what I've been doing. And in terms of experience, as I say, I started with audit and then tax, but that was all large quoted groups. And then I had a period of acting for both large groups and owner-managed businesses. And when I say large, one of the clients I had at that time had a worldwide turnover in the early 1990s of £1.5 billion. And I was responsible for the tax, basically. And I did owner-managed businesses. We dabbled in the voluntary sector a little bit. As I say, I learned the business side of owner-managed businesses whilst I was in York. And now I can handle most tax issues because of the wealth of knowledge and experience that I've built up. So a word on the profession. First of all, I'm going to quote a bit from this document, which is Open University. It's one of their developing your career sort of pamphlets they've got on the site. And this is on accountancy. I'll quote just a few things from it. It says, if you're logical, organized, analytical, and numerate, a career in accounting could be for you. Accountants work in all areas of business and in the public and voluntary sectors for employers in firms of chartered or certified accountants, or use their qualification to move into general management or set up their own business. Accountants in industry and commerce maximize profitability. In the public sector, the emphasis is on ensuring value for money. Some accountants specialize in audit, tax, like me, insolvency, which is either advising failing businesses or helping the creditors of failed businesses, or forensic accounting, which is extremely interesting. That's where if you maybe had an accident and you had a financial compensation claim, it would be the forensic accountant who would calculate it. It goes on to say that studying accountancy develops transferable skills that are highly valued by employers in all sectors, including critical thinking, problem solving, attention to detail, analysing, organising and planning, IT skills, and the ability to analyse and present data, and perhaps most importantly, the ability to explain complex ideas to others. Now, there's 6 accountancy bodies in the UK. 3 of them are chartered accountants. That's England and Wales, Scotland, Ireland. There's also certified accountants, management accountants, and the Institute of Public Finance and Accountancy. And a quick flavour, chartered accountants mainly work in practice. Some will work in industry, but generally at a higher level, maybe the FD of a quoted company. Certified accountants will work in practice or in industry, the main difference between the two is that the certified accountants don't do as much tax in their qualification. However, they often do the tax exams, and I know a few people who have done that. What we call SIPFA, public and chartered public and finance accountants, they work in public sector. It's a specialist skill and qualification. So local authorities, health authorities, and it's a highly prestigious qualification. And then if your thing is financial management and analysis in industry, then chartered management accountants is a qualification which helps you to do organizational management and planning. Okay. I just quickly want to look at the two institutes I'm familiar with and what you have to do to get into them. The ICAEW training is over a 3-year period. It can be extended to 5, but usually it's 3. It's on-the-job training with exams. You can enter it with any degree, and you'll work full-time with block release study and modular exams. You get a full-time salary and the employer will pay for the training. And the qualification is ACA, and then after 10 years of demonstrable experience, you will receive the FCA, the fellowship. And nowadays, there are joint Institute of Chartered Accountants and Institute of Tax training, sort of combined training, which is overall quicker, fewer exams, and you can specialize in which tax you want to do, companies, owner-managed businesses, or perhaps indirect like VAT. And recently, school leavers with A-levels can obtain apprenticeships to qualify as chartered accountants, and the employer obtains a 95% grant to cover the costs. And nowadays, there are even postgraduate studies that you can do which incorporate elements of the ACA qualification with practical work. And the Chartered Institute of Taxation, this is the Rolls-Royce tax qualification. There are 7 modular exams over 2 to 3 years, and you get the CTA qualification, which is an associate of the Chartered Tax Associate, it sort of means, these letters. The pass rate for each module is generally 50% plus, which might not sound great, but in my day, you had to do all the exams in one go, and the pass rate was about 1/3. And I've mentioned about the joint learning programs with both, in fact, the English and Scots institutes. Now, what's different with the Institute of Tax is that fellowship is obtained via a 10,000 word dissertation. So it's not as straightforward. There are a few people around who are very clever who've done it, and they are known as CTA Fellow. But finally, just a comment about all professional institutes. They promote and regulate standards in technical and ethical achievements and behaviour, but they also represent business and individuals to government and the civil service, particularly HMRC and the Treasury. They are lobbying, advising, and in some cases collaborating. And then just to finish this section, I'll just briefly tell you what I actually do, which is that nowadays I offer a tax consultancy service in that I don't do bookkeeping or prepare accounts or do tax returns, but I do work with other accountants and solicitors to help implement tax planning and carry out transactions. And I advise on most areas of tax, but I also specialize in particular sectors and also particular areas, such as property tax, stamp duty, land tax planning, research and development tax credits, which is a company tax relief, investment tax incentives, and I do a lot of work on business acquisitions and sales and reorganizations. Now, it's pointless, really, looking at coming changes to the tax system if you're not familiar with what is in there already. So I'll just give an overview of the main taxes we have in the UK. And the main tax, really the main tax is income tax. And in fact, the modern tax system started with income tax, and that was around 1799 to 1805. And it was basically thought up to raise cash for the Napoleonic War. I'll just state there's a difference between what's known as direct and indirect taxation. Direct tax is things like income tax, corporation tax, where you earn some income, you pay tax on it. Whereas an indirect tax is generally a transactional tax where you pay some money for something and there's tax on it, like VAT or stamp duty when you buy a house. And there's always been some sort of taxation, but in the UK, it was mainly customs duties and in fact stamp duty as well from about 1700. And there was even a window tax from 1695. And you may have come across that because all around the country, there are windows bricked up in buildings because that was an early form of tax avoidance. If you brick the window up, you didn't have to pay the tax. And the amazing thing about that tax, it was only repealed in 1854. An interesting snapshot of the Treasury tax take at the end of the 1800s shows customs £47 million, income tax £6 million, other £24 million, total £77 million. Well, nowadays it's 600 to 700 billion pounds. And income tax itself has been levied on and off in times of war. It was brought in to cover the cost of a war. Initially, only wealthy people would pay it, and they would be taxed on what was known as a scheduler basis. So their land would be assessed, their investments would be assessed, trading income would be assessed, all separately by different people. The idea being that nobody knew what the lord of the manor owned and earned altogether. But that system was only finally abandoned in 1996. Post-World War II, rates increased as government expenditure went up. Pay-as-you-earn was introduced, and tax rates increased until they were finally reduced by Margaret Thatcher in the 1980s, because the slice of the national cake taken by government was made smaller. And that trend of lowering taxes continues today. The system is increasingly digitized. For example, employment income and tax is embedded into a self-assessment tax return, taking the information direct from the information submitted by employers. And the initiative to that is called Making Tax Digital, but it's slow. What we wait to see is what's going to happen under COVID or after COVID. Capital gains tax is another major tax. It was introduced in 1965. Previously, income was taxed, but capital gains were not. And so there's quite a lot of effort to turn income into capital and avoid tax. So many anti-avoidance provisions were introduced, including the one that caught the Cleary sisters out, which became a famous tax case. They basically owned two companies. They needed some cash, so they sold one company to the other, taking the cash out of the other company, capital transaction, no tax. But that legislation caught them out, and it was taxed as an income distribution, which not only caught them by surprise, but probably the whole profession as well at the time. They didn't realise the implications. Now, why do I mention that? Because only last month I wrote what's called a tax clearance letter, a letter to the revenue outlining a transaction and asking the revenue to confirm they would not invoke that same legislation against my client, which they were very kind to agree. So it's very relevant today. Now, capital gains tax is characterised for me with the fact there's been so many changes of rules, but in practice that means that an advisor has to remember them all, but mercifully the pre-1982 ones are now spent. For example, there was the rebasing from March 1982, which basically pretended that capital gains tax started in 1982 instead. Inflation adjusted costs were allowed. Taper relief was introduced from 1998. And then in 2008, we went back to the pre-1982 rules. But there are some business disposal reliefs, which are very useful. Now, importantly, since 2010, capital gains tax rates have been substantially lower than income tax rates. What's going to happen post-COVID? For example, non-residents were never taxed on capital gains in the UK. It stopped at the borders in terms of residents, but now they are taxed if they dispose of UK property. So the net is widening. Briefly talk about estate duty, which is now inheritance tax. Estate duty was introduced in 1894 on land, and it replaced itself an earlier tax from 1694. It was originally a death duty and very easy to get out of, and it was extended to lifetime transfers in 1975 by the introduction of capital transfer tax, and that was changed to the current inheritance tax in 1984. And it's said that only 5% of estates pay it. But since what's called the nil rate band of £325,000 has been frozen for nearly 20 years, the 40% rate that applies above that has seen the tax take from inheritance tax rise from £2 billion in 2008 to £4 billion in 2014 to currently £6 billion. Now, that's not a lot in big terms. Income tax is about 70, 80 million. But it just shows how it's creeping up. You usually have to do long-term planning and just find the inheritance tax usually interacts with capital gains tax because they're the two capital taxes. Companies, they pay corporation tax, but again, only since 1965. Originally, they paid income tax like anybody else. But over the years, starting with very similar rules, they are changing, and especially since the 1990s. And really, we're heading towards a case where companies will be taxed on their accounting profits. That's where we're going to end up. But well over 95% of companies are what are called owner-managed businesses, family-run businesses. Now, the distinction of that is that they tend to obtain a tax advantage by running their business through a company because they can pay themselves a dividend. And they save very high income tax rates, they save national insurance, and they pay instead a much lower dividend tax charge. So that's maybe something again to look at, because I'm sure the Chancellor's got his eye on it. And currently, corporation tax for all companies is very, very low, 19%. But again, probably a prime target for post-COVID tax rises. I must mention stamp duty land tax because it's probably behind VAT becoming the commonest tax that people are paying. Stamp duty itself was last reformed in 1890, but then stamp duty land tax came in as recently as 2003. Stamp duty was brought in from Holland in about 1700, and it was literally a stamp on documents, and it covered almost any transaction that had to be covered by a document. But in later years, most of those have been knocked off, the latest one being the transfer or assignment of a debt. And now stamp duty only applies on share transactions. But property has been subject to stamp duty land tax since 2003. And when it came in, it was charged at 1%. But it was copied from Switzerland. And at that time, the rate in Switzerland was 11%. So it was pretty clear to us at the time which way it was going to go. And you can see this commercial property, the rates are up to 5% now. But on residential property, they can be as high as 15%. There's additionally 3% surcharges imposed on landlords, which tends to impact other people as well. And from this April, an additional 2% surcharge for non-resident purchasers of UK residential property. Scotland and Wales have different but very similar regimes. Now, currently, there's a COVID holiday on stamp duty land tax. It's fairly well known. If you buy a property for up to £500,000, you don't pay any stamp duty. Well, that's going to run out on the 31st of March. So let's see if it does or not. Mentioned VAT, you're probably familiar with that. You pay it. It's an EU sales tax. And the way it works is that value is added at each stage, say in a manufacturing process. And that value added is charged at 20%. So if you're a middleman, you pay input VAT on your costs and you charge output VAT on your sales, and you pay over to the revenue the difference. And then the end user, usually a consumer, pays the full VAT on the final price. But if you happen to be a business that can't register for VAT or for whatever reason, that input VAT becomes a cost which you then have to pass on through your sales or maybe your rent if you're a landlord. But overall, it's an excellent system and it's been copied. For example, Australia just took it on board. National insurance is worth mentioning. That's a levy on employment and self-employed income. But it is really effectively an additional basic rate tax charge. It's 12%. So the basic rate tax for an employee in the UK is 32%. But employers pay it as well. It's supposed to meet the real-time cost of social security, including state pensions. But the idea is the people paying it now pay for everybody who's drawing it now. And the problem with that is that demographically, as the number of older people get more and the number of younger people get fewer, who is actually going to pay it? So it's a bit of a nightmare. And some countries like Japan are finding it almost impossible. Other taxes are available. I won't go into any details of it, but there's one called the annual tax on enveloped dwellings. And suffice to say, it raises hundreds of millions of pounds. And then you get the odd one-off tax, like a pension fund raid or okay. So let's move on to what might happen post-COVID. Can you hear me all right, by the way?
Is it me a bit lagging?
Are you okay?
Yeah. It's a bit fuzzy.
Yeah, it just
yeah, like
is it
like intermittent.
It just told me my internet state. It just told me that.
Yeah.
Is it all right now?
It's a bit unstable. Your talk is intermittently being cut off.
Well, let me. I don't know why that is the case, but I will just attempt to rectify that before I go on.
Okay. Maybe you can check the Wi-Fi connection, or
just bear with me. I'll just try to a different one. I think. Let's see how quickly I can get it to.
Yeah, I think it's better. Oh, it completely cut off.
Right, how's that?
Yeah, that's better.
Okay, right, I'll carry on. Right. So what we're on to now is how the great difficulty is that we are not in the post-COVID era. We seem to be still right in the middle of it. But as far as I can see, there are three, which is what has happened or is happening. There's the imminent, which is what's going to be in the March budget and other measures. And then there's long-term structural changes that might happen. So what has happened? Well, we've already said, we've seen grants, we've seen lending, we've seen deferred payments of tax liabilities, we've seen changes, and we've seen a devastating effect on some sectors and businesses and employment. And we've seen, of course, empty city centres. The biggest question is, will support continue? We've currently got the furlough scheme where employers can pay employees to stay off work. That's not due to carry on a lot longer, but there's a lot of call for it to carry on because we're clearly not in a position yet to fully come out of these troubles. There's a business rates holiday. Again, that's due to come to an end. But there's a case, and the SDLT holiday I mentioned, that ends at the end of March, there's talk of that being extended. And where there's been deferrals of VAT and income tax, these are now due to start being paid, and there's a call for that to be extended. But also, the hospitality industry, as you know, has been totally devastated. Now, they currently enjoy, not that they can do it because they can't, well, I suppose they can do takeaways, but they only charge 5% VAT at the moment and not the full 20. And the advantage of that for them is that, of course, they are charging the same prices, but they're only having to account for 5% instead of 20% VAT. And a lady I know who runs a restaurant, she said it's been an absolute lifeline for their cash flow. So again, that's another thing. Will that continue? Now, what's likely to happen in the budget? The obvious question is, are there going to be any tax increases? The problem the government has is that despite a manifesto promise to freeze income tax, national insurance and VAT, the special circumstances we're in might make it too tempting to resist. So I wouldn't be at all surprised, assuming he's going to do it this time around, to see 2% on income tax, 2% on VAT, and perhaps another 0.5% on national insurance, because that is where the money is. If you want to raise revenue, they are the taxes that, because everybody pays them, you will raise the money you need. I mentioned about owner-managed businesses taking dividends out of companies. I wouldn't be surprised to see a hike in that tax rate by maybe 3%. And then corporation tax, that's quite low. And large companies until recently were paying at 28%. So maybe they'll be moved back to paying that rate, because then the vast majority of small companies will not be affected. And also it'll be seen to be fair because you're only paying the tax if you're profitable. I could see another 2% on stamp duty land tax. And very, very likely is that the currently low capital gains tax rates will be aligned with the higher income tax rates. As a political move, it won't raise much money, but it looks good. So your lower 10% will become 20 and your highest rate of 28 will bang back up to 40. But there must be a balance between supporting business and repaying government debt. And increasing tax at this stage might stifle recovery. And some would say, and I quote, maybe open up the economy rather than putting a boot into what's left of it. And personally, I would like to see a relaxation in some of the technical rules that are applied to companies. There are rules about a change of business. There's rules about reorganizing a business. And there's a lot of rules about the use of brought forward losses against future profits. And all of those, I think, should be looked at and relaxed to give businesses flexibility rather than suffering penalties, because many of them will have had to change what they do or reorganize how they do things. And it may well be that strictly the tax people will look at it and say, well, you've broken the rules, you can't have your losses anymore. And that would be completely unfair. And then also there's a call for increasing the rates of capital allowances so that companies and businesses can spend money on plant and machinery, get tax relief, and but boost the business and boost employment. And then one other idea, how about a new tax on property developers to offset the cost of grants to remove dangerous cladding? Okay, what might happen long term? Well, the OECD, the Organization of Economic Cooperation and Development, is 60 years old and it promotes international prosperity. And at the moment, it's consulting internationally on digital taxes, moving away from a physical presence in a taxing country, because that's the way things are going. Currently, permanent establishment rules mean that if an American company sells to the UK it will not be taxed on its profits. But if it sets up a base in the UK will seek to attribute profit to that base and tax it. So the idea would be to tax an entity in proportion to its economic activity in a country with no physical presence required. This would require some sort of turnover tax. Now, separately, they are looking at re-examining the profit shifting rules. You may remember there was a big fuss a few years ago because Starbucks had got a presence in the UK, they were making sales in the UK, but they weren't paying tax. And that was because legitimately they were making a commercial payment offshore, and that reduced the UK profits. The fact that where the payment was going to was a low tax jurisdiction, so they didn't really pay any tax, well, that was just tax planning. Now, the idea is to find some way of disallowing those payments so that the profits stick in the country where the activity is. And the other idea that's being floated around, but of course it requires international agreement, is to agree a global minimum tax of sort of 10 to 15%, so that any international entity has got to amalgamate all the forms of tax it's paid, including actual tax on profits, and demonstrate that globally that comes up to 10 or 15% of their global turnover. That, I think, is some way off. And some countries have said, well, we can't wait for you, and we've introduced our own rules, and the UK are one of those countries. Within the UK, digitisation is the buzzword. The aim is to reduce costs. It's easier to comply and harder not to. And they call it making tax digital. And it's coming in a big way for VAT, and it's coming in even more for that tax. They're looking at introducing it for corporation tax and for self-assessment. And I've already mentioned about them sourcing employment data direct from the employers. Internationally, worldwide, there is disparate progress. Apparently, Australia and Estonia are doing very well, but Canada is lagging behind and only just catching up with online filings. But the issue for international business is that poor interaction between tax regimes affects them. But there are concerns with digitisation. A big one is the cost of developing it, both for the authorities who are developing it, but also the cost that the individual taxpayers have to incur, perhaps getting new software or getting training and all that. Also, there's big concerns about data privacy and security. And then finally, if HMRC can now tell you exactly what way can you challenge those figures? And there was evidence of that. The early days of VAT making tax digital, I remember a case where an accountant was arguing on behalf of one of his clients with the revenue. They were demanding £1,500 and were threatening bailiffs and everything. And the accountant said the figure was exactly correct. But the point was, the client didn't owe it. The revenue owed the client. And then finally, of course, the EU. Are we in competition with them, or are we collaborating with them? Only time will tell. The other organisation worth mentioning is the Office of Tax Simplification. Their objective is to simplify tax through policy and administrative changes, removing tax distortions. On a personal note, their tax directors, past and present, include John Whiting, who was a former Pricewaterhouse colleague, and Bill Dodwell, a former Arthur Anderson colleague, who interestingly left Arthur Anderson to become Tony Blair's advisor on his Tony Blair government years. But he's back in the profession now. And the OTS have been credited with suggesting the introduction of the cash basis for small businesses, which has been very helpful. Nowadays, they are a formal statutory body and they contribute to the debate. And it is entirely possible fundamental changes will come to the UK tax system, but don't hold your breath. The first remit of the Office of Tax Simplification was to simplify or repeal 1,042 of them. And now There are 1,190 of them. Just to close, within the UK, there are some post-Brexit opportunities. There is a thing called UK to UK transfer pricing, which was just imposed on us by the EU because of fairness and everything. Well, that could possibly be withdrawn now, which would be very helpful. And rather amusingly, there's a thing called the patent box that was introduced by the UK government. It was to incentivize high-tech companies to come to the UK and pay. However, they were all coming from Germany. So Germany objected and the measures were watered down somewhat. So maybe they might be ramped up again. But the old adage that goes there, that one country's tax incentive is another country's tax abuse. So will we see, for example, a wealth tax on an annual basis or a one-off basis? Well, when the Labour Party came into power in the 1970s, they had said they would introduce a wealth tax. And after 18 months, Dennis Healey, who was the Chancellor at the time in 1975, said it's impossible to draft one which would yield enough revenue to be worth the administrative costs and political hassle. And others have said, history shows that a one-off wealth tax would be anything but. So will we end up with a turnover tax? What a great simplification. You can't avoid a turnover tax. You can't manipulate your profits. Or will we see the alignment eventually of tax and accounting profits? And then, who knows? Maybe one day there'll be a repeal of current property taxes like council tax, business rates, transactional stamp duty, and replaced by some sort of proportional property tax. Who knows? It's unclear. So in summary, with the pandemic still upon us, we are yet to come out of lockdown. Don't expect to see many changes. The big questions are, will support continue? And will some tax rates go up? Or will this all be left till next year? But there's no doubt that circumstances have already hastened some changes, and the move to digital tax has received new impetus. Time will tell. Time for questions.
Thank you very much for Duncan to share your insights with us. It's indeed a little bit laggy, but in majority we can do here a lot of great stuff. Yeah, and don't worry if the attendance is too low today, because the session is being recorded and will be shared to all the registered Leeds Finance Summit attendees, and they can review it later. Yeah,
that's fine.
There is currently no question in the chat box yet, but yeah, someone has raised the hand. You can just unmute yourself and ask questions.
So can you hear me okay?
Yeah.
Okay, great. So thank you for that, Duncan. That was a really interesting talk. So you said at the end there about one-off taxes, which usually anything but. If we do see taxes inevitably go up in the near future, do you really expect those taxes to come down anytime soon? Because for political reasons, etc., it's going to be pretty tough to bring taxes down. Do you see that at this point in time being probably a fundamental shift in the way we see taxation in the UK into the long run if they do inevitably go up?
I don't think it's inevitable they'd stay up. I think if you look at it at the moment, it's hard to see how they can do anything but raise taxes and keep them high until they get their finances sorted out. Having said that, I think the Bank of England have said that by this time next year, we could have double-digit growth. Well, if that's true, they're going to have very large, increases in the tax take because profits will go up. And I think it will be a juggling act for them. I think taxes will go up. And all of those ones I pointed at, I mean, from vast experience over the years, they are the ones that get the money in. A good example of that was when Gordon Brown introduced the banking levy it was on bonuses, and he said that They reckoned they were going to get £2 billion. But the tax was introduced for the period October round to April. So in the end, they only got 800 million because a lot of the banks just paid the bonuses in May instead. But what was just totally not noticed was that in the same budget, he put 0.5% on national insurance and raised £7 billion. And that's just an example of that, you know, you can do your flashy that look good, or let's have a go at this, but you're not going to get any money. But if you really want the money, then you go for the income tax and stuff. I think there will be raises and rises, but I think come the next election, they will want to show they've got on top of it and they can drop the tax rates down again. It's just a question of will they achieve it, you know?
Yeah, thank you very much.
I do have a question about your personal career path. How did you end up in opening up a tax consultancy company? And I'm quite curious about it. And like, have you, yeah, can you talk about a bit about your career path and how students
Well,
can get into this industry? Like,
yeah, it's quite difficult when you're in employment to take the plunge and you know, drop everything to set up because of the lag. However, I ended up quite lucky really because in 2010 there was a big financial crisis, and the firm I worked with, they valiantly tried to carry on, but I think they must have got to the point where the bank said no more, and they had they had a massive round of redundancies, and the 12 most senior people across audit, tax, and even a director left. But of course, were compensated. And that was the kickstart for me to be able to finally start my own business. When I had 10 years before left Arthur Andersen, people had said to me, "Oh, you're going to set up your own business," but I didn't really feel I got enough experience or knowledge. But those 10 years of learning the business side of family businesses was good, because previous to that, I knew a lot about tax, but not as much about actually running a business. And it's so important. That's why I say I do tax and business consultancy, because you can't spend nearly 40 years advising businesses without picking up some of the stuff that you can do as a business or not. But most important, I mean, I love working on my own. I work to my own terms. I can decide what I do or not. You know, and I'm not just sat there doing something because somebody else wants me to do it. But yes, you know, it's not easy. But having at the highest end of international business and big firm audit and tax, to looking after very small businesses, even the voluntary sector, which is quite an interesting sector to deal with. They don't really have any tax problems nowadays, because credit to Gordon Brown, he got rid of a lot of red tape for charities. But there was a time when they used to get tied in knots. So sort of working out solutions to practical problems, you know. And when I got the opportunity, and I must say I haven't looked back, I enjoy what I do. And, you know, I think I help people. And I can help people that otherwise, sometimes, you know, where would they go? Would they go to Deloitte's or somewhere? And, you know, for a complicated tax advice, which would cost thousands of pounds. Whereas I can probably deal with the same stuff at a fraction of the cost, you know. So that's a lot of my motivation. I enjoy what I'm doing, and it ends up helping people.
have COVID-19 impacted your business so far?
It did a little bit in the first lockdown. I was very busy in March, and up to the end of March, I had a few projects on, but it was very noticeable for about a month. Everything went very, very quiet. And then as we started to get out of it, May, June, things started to pick up again. And by and large, I've been carried on being fairly busy, mainly because there's two different things I do. One is I'm helping people with things they did last year, and I'm helping with people with things they are doing now or are about to do. And between the two, it sort of provides a bit of continuity, because obviously during 2020, I was mainly helping people with what they've done in 2019. And maybe not so much has gone on in 2020, but on the other hand, the other side of it, people are trying to buy a house because of the stamp duty holiday, but suddenly finding they've got the 3% surcharge to pay. So I'm helping deal with that, because sometimes you can actually get out of it. And when it's going to cost somebody 10, 15, 20,000 pounds, it's worth getting some advice on it.
Yeah.
So, but I have seen a lot of businesses impacted. And I've been amazed how resilient they've been. There was one in the entertainment industry who, around Christmas time, they were selling Christmas wreaths because they just totally reinvented the business. I really take my hat off to them.
And I do have a bit of interest on like how government help bail out those individual businesses during lockdown, and is there any like tax alleviation and something about furlough? Yeah, I do want to know more about this.
Furlough. Well, furlough was the term given to laying off employees.
Yeah.
Initially, the government will pay 80% of their pay.
Mm-hmm.
So the business, there was a business here who the week before it was announced, they were having meetings in the open area that's just outside my office. And the guy was having to say to one after the other, this is how we're going to have to try to survive. They had no money coming in at all. And then when they announced the furlough scheme, I said to him, "Is this helped?" He said, "Oh, it's a total lifesaver. We can pay everybody, Now that was the furlough scheme, and it's been, originally it was a short term, but they just had to extend it. The other help, one very good bit of help, was that small businesses who were registered for business rates, they each got a grant of £10,000, and that was very helpful.
Mm.
What has been less helpful has been the help for self-employed people, where there were they had to do it some way, but the set of rules they concocted meant that a lot of people just totally fell through the gap and didn't get any help at all. And there's been some criticism of that. Only this last week, again, the Chancellor's been challenged that about 3 million self-employed people have totally got no help at all. And all he could say was he didn't recognise the figure. So, I think to a certain extent it is what it is. Maybe one thing that isn't appreciated is that the self-employed people who received the self-employment grant, the revenue will expect them to include that in their taxable turnover. And I don't think they probably mostly understand that. I think it's some sort of tax-free grant. So I think accountants are going to have their work cut out explaining that one to their clients. Yeah.
You can just ask if you raised your hand.
Hiya. Just one question. Something that I've always sort of thought about the UK income tax system is why we don't have more brackets. So like I think the top one's 150,000. But then of course there's people with say a lot more money than that, and then a lot more money than that. I was just wondering what your thoughts are in terms of having more brackets and more increments.
You mean above 150?
Yes. So say if it say wasn't 45% at 150,000, say if it was less than that, but then people who earned say more than that, it was, I don't know, is that making sense? So like,
yeah, no, I understand what you're saying.
Yeah.
It's an interesting question. I think the practical answer to that is that the thing is that people who've got that amount of money can usually, to a certain extent, decide how much tax they pay. And if the tax rates are too high, then their incentive is to not pay it by finding a way of not paying it, which is not,
yeah.
I don't mean evasion where they say, oh, I've earned the money, but I'm just not going to pay. I mean, finding a way of rearranging their affairs because they're in a position to do that. Interestingly, and I know the Liberals got really upset about it at the time, but in the coalition government, they'd introduced this top rate of 50%. And the government asked HMRC, who have all the detail on this, to do a review of the 50% rate, and for 12 months. And at the end of 12 months, HMRC's advice was to lower the 50 to 45 because they said there was evidence of people avoiding paying it. And they thought if they dropped it to 45, they would actually get more money. And that proved to be the case. The Liberals thought this was terrible. The rather bizarre outcome of that was that they only said they would support it if the then Chancellor included some measures that they wanted put in. And they were the most bizarre things because they were doing things like trying to restrict relief for donations to charities, which blew up in their faces because the charities all said, look, if you resist this tax relief, we will not get the money that we used to get in, and they all had to backtrack. So, but the thing is, I mean, I had a client who, the other thing that happens, if your income goes above £100,000, you start to lose the personal allowance, which is currently 12,500. You lose £1 for every £2. So once you've got up to 125,000, you don't get any personal allowance. Well, when you think about it, if you're paying tax at 40%, but you're also getting an additional pounds tax for every £2, you've got a marginal tax rate of 60% in that band. Now, a marginal tax rate of 6% is pretty high. And I had a client who was thinking of paying himself a dividend, and he asked me to do the calculation to work out how much dividend he could take that got him up to 100,000, but no more, because he would just simply wouldn't go above that. Now, that's the sort of thing. That is why capital gains tax rates are lower, because it was found that when capital gains tax rates were the same as income tax rates, 20%, 40%. And of course, if you make a big capital gain, you are going to put yourself into the 40% bracket. People would say, 40%? I'm not paying that. So they go, tell you what, I won't sell it. Or no, I'll tell you what I'll do. I'll transfer it in bits over years so that I can use up lots of annual exemptions. And so there was whole scale avoidance of paying high capital gains tax rates. So the government said, well, I'll tell you what we'll do. We'll introduce these lower rates. And in fact, the main rates of capital gains tax are 10 and 20 at the moment. And people say, oh, I can pay that. I can live with that. So they go ahead and do the transaction and pay the tax. And so the tax take is quite high. And I think if you started introducing whatever, 50, 60, 70% tax for much higher bands, you'd just find, if say a big business thinks, right, we need to get a corporate executive to come in and run the company, or the best guy is that guy in France, he'll say, I'm not coming to your place because I'll have to pay too much tax. And it starts to hamper economic activity. And I think that's the thinking behind it.
That makes a lot of sense. I think it's very interesting what you've said there. But also, I think, like, instead of changing, say, increasing it to 70%, like in my head, I'm thinking, right, there's quite a big difference between somebody who earns, say, £250,000 a year and somebody who earns borderline £1 million a year, brings in. So I was sort of thinking, how, like, why is it so everybody who earns over 150,000 pays the same, even though it can go so much higher than that level?
Well, they are paying a lot of tax when you think about it. There's interesting, as I say, the revenue, you've got all the information. The top, I think the top 1% of taxpayers pay 30% of income tax. I think the bottom 50% pay 15% or something. And the top 1% pay 30%, twice as much as the bottom 50% in total. It's a lot, because when you think these footballers on 100,000, 200,000, or whatever it is a week, they will be paying pretty well half of that away in tax. And you've got to remember that they're paying national insurance as well. And the company's paying national insurance. So I think they'll be paying 47%, but the company will also be paying whatever the company's national insurance rate is, about 13% or something.
Yeah.
So if the pay is 100, 60 of that 100 is being paid as tax, because national insurance is tax. So it's already pretty high.
Yeah.
You
Yeah,
think?
that makes much more sense. Thank you.
Yeah.
Thank you. What about Michael? Do you have any question to ask?
I've got, yeah, have you got time for one more question?
Yeah, I think we can take the last question.
Great. I just wanted to see what is your, personal opinion on striking the balance between, increasing taxes, raising funds versus maintaining, investment incentives so we can get the economy going again. What do you think is the best way to strike that balance?
Personally, I'm in favour of stimulating the economy. I think if you've got a reasonable, fair tax system, if you can make the economy work, tax revenues will go up, because basically more people will be earning and more people will be paying tax. So as long as they're reasonable rates, then they will make the money. It's an interesting question, this thing about companies. Why shouldn't large companies pay more tax? And I think there is an argument for it. I don't know why large company tax was reduced so much, really. I can't really understand what was behind it, because why shouldn't a large company making $1.5 million profit, or if there's 5 of them in a group, then between them it's a lot of money. Why not pay a bit more tax, especially as the vast majority of the owner managed businesses are not paying that high rate? So, but to punitively tax I just think it's see, there's something going on at the moment with non-domiciles. For many years, the people like the Arabs would put a lot of investment into Britain, and then suddenly, for some reason, I think some MPs woke up to the fact that there were these Arabs living in the UK, and they weren't really paying very much tax, because it seemed what was happening at the time was that they would individually just do a personal deal with HMRC as to how much. I'll pay you $500,000 this year. Is that all right? So, yeah, fine. Because the millions that they were investing, creating employment and all of that stuff. If you set up a business and create employment, you've got sales and sales taxes, you've got employment taxes, and you are generating economic activity, and it's generating a lot of tax. And you can see that. And if you start going, oh no, I'm going to start tax them all, it's just going to quench that. And this thing with the pace I'm using, because when it was first in, basically what it said was, if you successfully took out a patent on something, then profits you make from the use of that object will only be taxed at 10% instead of the 20 or whatever it was. But the rules said that if you incorporate that as a component into something, then the profits on that thing are taxed at 10%. So if you got a patent on a nut for the wheel of a car and then made the car, you'd be paying 10% tax on the whole of profits on the sale of that car. Now, that was a bit extreme. And the Germans said, you can't possibly do that, because, of course, what was going to happen was that loads of companies that at the time anyway, we're in Germany, we're going to go, whoa, free movement in the UK. Yes, please, into the UK. So you can see how tax incentives help, but when do they become abusive? And it's got to be sensible. The thing about capital allowances, I don't know if you understand what I mean by those. There's a distinction between capital and revenue. So if you had a cave and you put some shelves up and you got some stuff and put it on the shelves, and people came in and bought the stuff off the shelves, any costs on the cave is capital. It's your shop, it's your structure. What you're taxed on is the income you're deriving from the buying and selling of the stuff. So there's a distinction. But to encourage manufacturing in particular, certain capital expenditure gets a tax allowance. It used to be factories would, but they stopped that. But now it's things like your plant and your machinery, your production line. Now, how much of a rate do you get? Well, it's banged and pinged back and forth over the years, but currently there's a very clever idea, and I think it's another of Gordon Brown's. It's called the annual investment allowance, where the first certain amount you spend, it doesn't matter what you spend it on, you can have pound for pound tax relief. And that is very helpful, but it's gone from 20,000 to 500,000 to 100,000. It's like this. And businesses just don't know where they are. And the call is to put it up to £1 million or even £2 million and just leave it there, so that companies will say, you know, we will buy that machine because we get tax relief on it, and we need 10 people to run it, so that's 10 jobs. And that is the sort of thing that, you know, you would, I quite like Rishi Sunak, and I do hope that he, you know, is sensible and will think about things like this. A previous incumbent, Osborne, he was terrible. I think he was one of the worst chancellors we've had. I don't know what it was that was wrong with him, but so many in the profession just disagreed. Obviously, people politically disagreed with him, but some of the things he did just seemed counterintuitive. Whereas Sunak, he does seem to be listening, you know, and I've just got to hope, really. In actual fact, I've got on my list of things to do a budget representation to make, because I think, well, why not? Because there's something I've spotted, which I just think is becoming an anomaly. I'd probably be totally ignored, but it's worth seeing if he'll listen, you know. Because it's why? Because I think it's a tax charge that is happening, which I think is making people think, oh, I better not do that then. And you think, well, hold on, why not? Oh, because of the tax. And it's stupid. When tax distorts people's activity, there's something wrong with it. That's what I think.
Thank you very much for your questions. And thank you for thinking can come to Leeds Finance Summit today. Hope you enjoyed it. Yeah. And see you tomorrow, guys. I think, and meeting here. Bye.
Thank you, Duncan.
Okay.
Thank you.